Retirement planning. Well, retirement planning is about ensuring that there is adequate income to meet the expenses in the retirement stage of an individual's life cycle. There are few things you need to know before we get into the calculation. One is living expense. This comes from the cash flow analysis, and this includes both fixed and variable expense. The next item you need to know is when do you plan to retire, at what age, and the third is your life expectancy. So let's say you are 30 years of age and you decide to retire at 50, and based on your family history you think that your life expectancy is 80 years. How do you understand that? What is the kind of retirement fund that you need, or retirement corpus as we call it, at an age of 50 when you retire? So that money will be sufficient to meet all your expenses within the range of 50 to 80 years when you're not really earning anything. So time period from 30 to 50 is also called earning life, because this is the time when you will be earning, and 50 to 80 is called the retirement period or retirement life. So let's say for example that you arrived at your current living expenses as 1.5 lakhs per month, or say 18 lakhs per year. Basis this, what is the kind of retirement corpus you need to have at an age of 50? So there are two ways to do this calculation. One is a simple way, the other is more complicated, or I would say financially oriented way. So let's talk about the simple way to calculate the amount of retirement fund. So it's simply current annual living expenses multiplied by retirement period. As you can see that our retirement period given the example is 30 years, that is 80 minus 50, and the retirement fund basis 18 lakhs of yearly expense will come out to be 5.4 crores. This is 18 lakhs multiplied by retirement period 30 years. So for those who do not want to get into the financial calculations a lot, this is a good ballpark number that you can focus on. So now let's bring in investment return and inflation into the calculation. Before we get into the calculation part, we need to understand three concepts: future value, present value, and payment. We have briefly discussed about these topics, future value and present value. We'll be just extending that conversation now by bringing in yearly investment concept. So let's take two examples. One is 10,000 rupees invested every year for the next 5 years, earning 10% per annum. What is the future value? That is, at the end of 5 years, what is the value of that money? And the second question is 10,000 rupees invested every year for the next 5 years at earning 10% per annum. What is the present value today of that money being invested? We understood in time value of money that future value is equal to present value multiplied by 1 plus investment return, or R, raised to the power n. So when we see these numbers, what we really need to know is apply this formula of future value on each of these data points. That is principal present value multiplied by 1 plus R, which is 10%, raised to, so this money is invested for 5 years. Similarly, in the second year, this money gets invested in for 4 years. In the third year, this money gets invested in for 3 years. In fourth year, this money gets invested for 2 years. And the last year money is invested for 1 year. So the future value of all these would be sum of all these numbers. So we invested 50,000 rupees. That 50,000 at the end of 5 years will become 67,156 rupees. Well, we saw this as future value calculation of 5 years, 10,000 rupees invested at 10% per annum. Now there is an inbuilt Excel function to do this, equal to FV. Rate is 10%. NPER stands for time period, which is 5 in this case. Payment is 10,000 every year. We don't have a present value here. Type stands for the money being invested at the beginning of the period or end of the period. So type denotes whether the investment, the payment is done at the end of the period or beginning of the period. So 0 stands for end of the period and 1 is the beginning of the period. And Excel takes as a default option 0, which is assuming it is end of the period. So you will see that if I don't put anything here, it will assume end of the period and our numbers will not match. It will assume that at the end of first year, the first payment was done, which is not the case. 10,000 rupees invested today, then at the beginning of second year, then beginning of third year, and so on. So that is why we need to put type as 1, stands for beginning of the period. So now we see that how the same concept is applied on the present value. So we have a question here which is 10,000 rupee invested every year at 10% per annum. What is the value in today's term? Well, we can use the Excel based formula, which is PV. Rate is 10%. NPER is 5, stands for the period. Payment is 10,000 rupees. We do not have a future value here. And the type is again 1. So if you're looking at this for the first time, this may be overwhelming, but if you try and practice it, you will get better. And above everything, even if you don't want to do this by yourself, and let's say if you hire a financial advisor who is, let's say, a CFP, you will know what that person is trying to do. So now that we understand the concept of future value, present value, and payment, let's apply these concepts to our retirement analysis example. That is, your current age is 30, you plan to retire at 50, and the life expectancy is 80 years. Let's assume that inflation is 7% and return on your investment is 10% per annum. So as you can see that our earning life is from 30 to 50 and from 50 to 80 is the retirement period. So for simplicity, I have created an Excel for you. If you open up the Excel with the name retirement planning, so this calculation can be done by filling these few numbers and automatically you will get what should be the retirement fund. For example, we understood that your current age is 30, you expect to retire at 50, your expected life is 80 years, your current living expenses are 18 lakhs. So we know that we calculated 5.4 crores in case there is zero inflation and zero growth in your returns. Now we add little bit of inflation, that is 7% we assumed, and we also assume that the rate of return is 10%. And that is in case of both the returns that you earn before retirement as well as after retirement. For simplicity, I'm assuming 10%. So usually once you are into retirement, your returns would be lower because you tend to invest more conservatively. So you need to have 14 crores in order to retire at an age of 50. So we saw that at an age of 30, if you plan to retire at 50 and your expected life is 80 years, current living expenses 18 lakhs per year, you need 14 crores to retire at an age of 50. The number becomes 14 crores due to inflation, because earlier when we were assuming inflation as 0%, the value of this money would have been 5.4 crores. So we assume that inflation is 0% and your returns are 0%. So we see that 5.4 crores was your requirement. However, when the inflation became 7% and your returns that you expect pre and post retirement is 10%, the retirement fund requirement became 14 crores. So from a practical perspective, what is the worth of this 14 crores in today's time? That will be the present value, which is 14 crores divided by 1 plus 10% raised to 20 years. So this gives us the value in today's term. So the worth of this 14 crores is 2 crores in today's time. So now we do little bit of a variation here from your understanding. Oftentimes people want to know at what age they should retire. Let's say your age is 30. Instead of retiring at 50, you are making an assessment whether you can retire at an age of 35, assuming the living expenses remain as 18 lakhs. So by the time you are 35, your requirement of having a corpus is 6.4 crores. Let's say you already have 3 crores. So the deficit is 3.4 crores. Now you need to reflect whether next 5 years, depending upon your nature of work, will you be able to save that much money or not. If the answer is yes, then you can very well plan to retire at an age of 35. And always bear this thing in mind that retirement planning is also called financial freedom. So at an age of 35, when you are actually retiring, you are attaining a financial freedom. That does not mean that you will be sitting at home. That could actually mean that you do something of your interest, your choice. So you are going out for work, not for money, but for your own psychological aspirations. So do not assume that retirement actually means the retirement of traditional time at an age of 60, sitting at home. So this retirement should be really taken as how quickly can I be financially free so that I do what I love doing. So now I would request you to spend little bit more time on this Excel, reflect on your requirements and see where you are today and where do you want to reach in next couple of years. So retirement is the most important goal that you need to plan for and you need to save for. Thank you for watching.